Welcome back to Simple Mind Space, your go-to podcast for mastering your money and your mind. Today, we're diving deep into the world of dividend investing, demystifying the process, and showing you how to build a rock-solid dividend portfolio that generates passive income for years to come. Imagine this. You own a piece of a company that consistently rewards you just for holding on to it. That's the beauty of dividend stocks. These aren't just any companies. They're established giants with a proven track record of sharing their profits with investors like you. It's like getting a regular paycheck, but instead of clocking in, you're simply reaping the rewards of smart investing. Let's break down how this works. Imagine you purchase 100 shares of a company at $10 per share, totaling a $1,000 investment. Now, let's say this company generously offers a 50-cent dividend per share. With your 100 shares, you'd receive a cool $50 annually, a solid 5% dividend yield. That, my friends, is passive income in action. But why choose dividend investing over other options? Let me count the ways. First and foremost, it's the epitome of passive income. No need to hustle, no need to grind. Your money works for you while you enjoy life. It's like having a silent partner generating a steady stream of cash flow. And here's the kicker. Dividend stocks have historically outperformed the market. That's right. By factoring in those consistent dividend payments, your returns have the potential to soar above average market gains. It's like having your cake and eating it too. But wait, there's more. Dividend portfolios are your shield against market turbulence. While high-growth stocks might plummet during corrections, dividend stocks hold their ground, providing a sense of stability that can be a lifesaver in uncertain times. And let's not forget the tax advantages. Unlike your regular income, dividend payments often enjoy lower tax rates. In many cases, they're taxed at the favorable long-term capital gains rate, putting more money back in your pocket. The magic of compounding is another compelling reason to embrace dividend investing. Imagine reinvesting those dividends back into the same company, purchasing more shares and amplifying your future payouts. It's a snowball effect that can lead to substantial growth over the long haul. Now, let's address the elephant in the room, the potential downsides. While dividend stocks offer stability and income, their growth potential might be more modest compared to their high-growth counterparts. This is because dividend-paying companies prioritize sharing profits with investors, leaving less capital for reinvestment in their own expansion. Remember, dividends aren't etched in stone. Companies can reduce or even suspend dividends if they face financial headwinds. It's crucial to choose companies with a proven track record of consistent and increasing dividends, ensuring your passive income stream remains reliable. Ready to embark on your dividend investing journey? Let's map out a clear path to success. First things first, you'll need a brokerage account. There are tons of options out there, but I always recommend exploring those that offer enticing perks, like free stocks, to kickstart your portfolio. Once you've chosen your platform, funding your account is the next step. Think of this as planting the seeds for your future financial growth. The more you invest, the more you stand to gain from those sweet, sweet dividends. Now comes the exciting part, selecting your dividend investments. Don't be overwhelmed. There are resources available to guide you. Websites like Verify offer comprehensive lists of dividend ETFs, providing insights into their performance, expense ratios, and more. Another valuable resource is MarketBeat, allowing you to sort stocks by dividend yield. Remember, while a high yield might seem tempting, always prioritize quality and sustainability over chasing those potentially risky dividend traps. Once you've identified promising investments, it's time to pull the trigger and make those purchases. Most brokerage platforms offer a seamless buying experience, making it easier than ever to build your dividend empire. Safety should be your North Star when navigating the world of investing. Always invest with an amount you're comfortable potentially losing. While the risk of losing everything is relatively low with traditional stock investments, it's always wise to prioritize capital preservation. Remember, knowledge is power. Dedicate time to research each company you're considering, ensuring their risk profile aligns with your own investment philosophy. Develop your own set of rules and guidelines, sticking to them diligently to avoid impulsive decisions driven by emotions. Let's dive into the key metrics that will empower you to make informed investment decisions. Understanding these metrics is like having a financial compass, guiding you towards companies with the strongest potential. First up, the 10-year average return. This metric provides a glimpse into the long-term performance of an investment, offering valuable insights into its historical profitability. By examining this metric, you can assess whether an asset has consistently delivered returns over a significant period. Next, we have the dividend yield, a crucial metric that reveals the amount of cash flow you can expect to receive from your investment. Remember, while a high yield might seem alluring, it's essential to prioritize companies with sustainable payout ratios and strong financial fundamentals. Diversification is the bedrock of a resilient portfolio. By spreading your investments across various asset classes, industries, and geographies, you can mitigate risk and reduce your portfolio's vulnerability to market swings. When considering dividend ETFs, the expense ratio deserves your attention. This metric represents the annual fee charged by the fund manager, impacting your overall returns. Aim for ETFs with expense ratios below 0.1% to maximize your investment's efficiency. Total return encompasses both dividend payments and capital appreciation, providing a comprehensive view of an investment's performance. By focusing on total return, you can identify investments that generate income while also appreciating in value over time. Earnings per share, EPS, offers a glimpse into a company's profitability on a per-share basis. Consistently increasing EPS is a positive sign, suggesting that the company is efficiently growing its earnings, potentially leading to higher dividend payouts in the future. Now, let's shed light on some common pitfalls to avoid when building your dividend portfolio. These insights will help you sidestep potential traps and make savvier investment decisions. Remember, dividend investing is a marathon, not a sprint. Don't get caught up in chasing short-term gains. Focus on building a portfolio of high-quality companies with a history of steady dividend growth, providing a sustainable stream of passive income for years to come. Targeting multiple industries is crucial for a well-diversified portfolio. Economic cycles impact industries differently, so by diversifying across various sectors, you can mitigate risk and potentially enhance your returns. Aim for a mix of stable and growth-oriented industries to balance risk and reward. Financial stability trumps growth potential, especially in the realm of dividend investing. Look for companies with strong credit ratings and healthy balance sheets, ensuring they can weather economic storms and continue rewarding shareholders with consistent dividends. Pay close attention to payout ratios, a metric that reveals the percentage of earnings a company distributes as dividends. A sustainable payout ratio, typically below 60%, indicates that the company retains enough earnings to reinvest in growth opportunities while still rewarding shareholders. Don't fall into the trap of chasing high dividend yields without considering the company's underlying fundamentals. These dividend traps often signal underlying financial weakness, potentially leading to dividend cuts in the future. Prioritize companies with sustainable dividend growth and strong financial health. Look for companies with a history of consistently increasing dividends. This demonstrates their commitment to rewarding shareholders and suggests confidence in their future earnings potential. Dividend aristocrats, companies with a long history of dividend increases, can be a great place to start your research. Finally, consider reinvesting your dividends, especially if you don't need the immediate income. Reinvesting allows you to harness the power of compounding, accelerating your portfolio's growth over the long term. It's like putting your money on autopilot to work towards your financial goals. Let's explore different dividend investment strategies that align with various investment goals and risk tolerances. These strategies offer a roadmap to navigate the world of dividend investing and maximize your chances of success. Dividend growth investing focuses on companies that consistently increase their dividends year after year. This approach offers a potent combination of income generation and capital appreciation, as these companies tend to reinvest their earnings strategically, fueling future growth. Dividend capture investing involves holding stocks just long enough to receive the dividend payment, then selling them shortly after. This strategy can be riskier and less efficient than dividend growth investing, requiring careful timing and market analysis to be successful. Dividend reinvesting, as discussed earlier, involves automatically reinvesting dividend payments back into the same company, purchasing additional shares, and amplifying your future income stream. It's a powerful strategy to maximize compounding and accelerate your portfolio's growth over the long haul. Remember those dividend traps we talked about? Let's delve deeper into identifying and avoiding these potential pitfalls. By understanding the warning signs, you can safeguard your portfolio and make more informed investment decisions. The price-to-earnings PE ratio is a valuation metric that compares a company's stock price to its earnings per share. A high PE ratio might indicate that the stock is overvalued, while a low PE ratio might suggest undervaluation. However, it's essential to consider industry averages and other factors when interpreting PE ratios. Free cash flow represents the cash generated by a company's operations after accounting for capital expenditures. Strong free cash flow is crucial for dividend sustainability, as it indicates the company's ability to fund dividend payments without jeopardizing its financial health. The debt-to-equity (DE) ratio measures a company's financial leverage, indicating the proportion of debt used to finance its assets. High DE ratios can signal higher risk, as the company is more vulnerable to interest rate fluctuations and economic downturns. As we wrap up our deep dive into dividend investing, let's recap the key takeaways to guide your investment journey. These principles will empower you to build a robust dividend portfolio that generates passive income and withstands market volatility. Dividend investing is a long-term game, not a get-rich-quick scheme. Approach it with a patient and disciplined mindset, focusing on companies with a proven track record of sustainable dividend growth and strong financial fundamentals. Diversify your portfolio across multiple industries and sectors to mitigate risk and reduce volatility. Aim for a balanced approach, incorporating both stable, dividend-paying companies and those with higher growth potential. Prioritize financial stability over excessive growth when selecting dividend stocks. Look for companies with strong credit ratings, healthy balance sheets, and sustainable payout ratios, ensuring they can weather economic storms and continue rewarding shareholders. Don't be fooled by high dividend yields without scrutinizing the company's underlying financials. Scrutinize their earnings, cash flow, debt levels, and overall business model to ensure the dividend is sustainable and not a red flag for potential trouble. Reinvest your dividends whenever possible, especially if you don't need the immediate income. This simple yet powerful strategy allows you to harness the magic of compounding, accelerating your portfolio's growth over time. Remember, building a successful dividend portfolio takes time, research, and discipline. Stay informed, stay patient, and stay focused on your long-term goals. By adhering to these principles, you can create a passive income stream that will serve you well for years to come. That concludes our exploration of dividend investing. If you enjoyed this episode and found it valuable, be sure to like, share, and subscribe to Simple Mind Space for more insightful content on mastering your money and your mind. Until next time, happy investing.